part 2 of our introduction to the smart money concept. Hello traders, welcome back to my YouTube channel. In the last video we started by explaining the concept of smart money. We defined what smart money was all about. We talked about liquidity, we talked about supply side liquidity, demand side liquidity, and all of that. So we are going to continue from there, and if you have not watched the video, I'll recommend you go back and watch the video. I shared with you guys a series of examples from our live chat, and today we are going to continue with part 2 of our introduction to smart money concept. So if you haven't watched the part 1, I will recommend you go and then you watch, check in the video's description and above there. Okay, so in today's video we'll be talking about what is distribution and what is accumulation as part of the terms or the concepts used in the smart money concept as a whole. So we equally be talking about mitigation by the banks and institutions. What is the meaning of mitigation by banks and institutions, which I usually call the big boys, and I will show you guys chart examples from forex, forex pairs, metals, even indices, alright, to show you that this concept works everywhere. Okay, so about distribution and accumulation. Okay, from our explanations in the last video, we actually said that whenever we find consolidation between a demand or a supply zone, or when price get rejected in a particular zone once, twice, and thrice, it usually create liquidity, which is sometimes known as the demand side liquidity. We have the supply side liquidity as well. So we actually explain that when price move up, it get rejected, it comes to get rejected. Alright, liquidity lies below the zone and above the zone. So if price move like this is in order to grab liquidity, later on it continues respecting, while up it moves and then it grabs liquidity and it continues moving down. Okay, so now this is actually the thing. It falls under the concept of accumulation and distribution. Okay, so if you find a resistance zone like this, with this zone here and then with liquidity above, we equally have a zone like a demand here with liquidity below. Okay, if price move and then it get rejected once, okay, it get rejected twice, it get rejected, and it goes the third time, okay, it get rejected and then it close above. So distribution is when price take out the highs before still continuing in its normal pattern. Alright, like for instance, if price move, it creates a high, it get rejected here, it comes, it get rejected, it goes rejected, it get rejected. It comes a point where you see price move up and then it takes out this high, and when it takes out this high, like what we explained in the liquidity grab scenario, sometimes it will continue and then it keeps respecting the zone. Okay, so when this happens, taking out this high before continuing is the concept known as what we term this to be what we call distribution. Okay, so this is actually what we call distribution. Now if price happens to move and then after creating these zones here, it consolidates and then it creates a supply zone. So why, if price moves down and then it takes down these highs after creating a demand zone, it takes down this low before continuing up and continue respecting the pattern, this is what we know as accumulation. So here we have accumulation and up there we have distribution. So this is known to be accumulation. Okay, so that is accumulation. This is what is referred to as accumulation, which is actually falling under the liquidity grab concept that we have explained in this series part 1. Alright, so we have distribution where price creates a resistance zone and manipulates the high. After taking out the highs, it continues its normal routine, while for accumulation, when price takes down or takes out the lows and later on it continues going up, it's known as what? Accumulation. So it breaks. Sometimes you will not just go up immediately. Sometimes after grabbing the liquidity, you see something like this, it retests and many people will jump into selling. So we have traders who jump into selling because they think that okay, this is a retest. It start going down a little bit, and afterward, what happened? It close above the zone. When it close above the zone, it moves up. So this is basically what this a situation where you see a situation of accumulation. All right. So let's just look at gold. This is an example here in gold. We have a situation which is a beautiful situation. So you can just see that price got rejected. We got a rejection, and then when it came down, what happened? So after this rejection, this last rejection, it got rejected a little bit for those people who rushed into selling, into buying, and then it came and retested. Many people entered, sell others. What happened? It came down a little bit, and then what happened? It closed above the zone, and boom, you can see that's how it moves. And you realize here that we have very strong bullish move. This is a perfect example of this concept. All right, so it works just everywhere, guys. Now we can go. Let me share with you another indices. Let's just change symbol, and then maybe we'll get to something else. Synthetic indices, forex, whatever, synthetic indices. Let's go to jump 10. We are going to see similar scenarios, and anyways, these are trades I took based on my other analysis, but we have a situation like this that applies. We have price, it goes up and then it gets rejected. What happened? It breaks the zone, it comes back, and then it closes below the zone, it moves down. We have many of those scenarios, and I can show you more and more and more. We have, let's go to volatility 75. So this is it here. We have a zone, and gets created, it gets rejected once, twice. Okay, what happened? It breaks through. When it breaks through, we actually had a scenario where it came and then came retested, came back and then closed above the zone. What happened? We have a strong move. So this is actually what accumulation that happened here. Okay, so we equally have scenarios of distribution. This is distribution above that happened. We had a zone created here which was a supply zone. So we got the rejection once. Okay, let's expand it to be a zone. Okay, so we got the rejection, we get the rejection, we got rejection a couple of times. Okay, so what happened? Price moved up and closed above the zone, came back, retested, and then it moved up. When it moved up, now you had more buy orders coming in, and the price moved down. So this is actually an aspect of what? Distribution, accumulation. So that's basically it. This is just an introduction. This is just an introduction to this concept, and I can go on to show you more and more scenarios. So that's it, guys. That is basically it. Now in part 3, we are going to be speaking detailedly on these other aspects. We are going to talk about in part 3 of this series. In the next video, in part 3, which is the next video, we are going to be talking about mitigation. All right, we'll talk detailedly on this. I will show you mitigation. I will show you a lot of trades examples in currency pairs, wherever. So I can equally go back to currency pairs, and then I show you more and more examples. I will show you what how banks, in that part 3, I will show you exactly how banks operate. I will show you how they hedge, they buy and sell, and they cause price to move. Exactly why you see scenarios like this, why you see scenario like this. I'm going to explain to you so that you understand the concept detailedly in part 3 of this video. So make sure you subscribe to this channel, click on the like button, click on the notification bell so that you don't miss out on any of the posts that we'll be making. Thank you for watching. See you in part 3 of this video.